So we can see what happens when you add assets and liabilities that are typically not used in the investment side of the balance sheet. So, for example, here I've added John Saw's pension. He gets about $1,500 a month. He was in the military, and after 20 years, you get a pension for life, and you can go and get other jobs and so forth. So he's got that, but its present value is $391,500. Now, the reason why this is rarely on a balance sheet is because how long is this bond-like instrument? I say bond-like because it has a cash flow every month for the rest of his life. And we don't know when that's going to be. So most advisors and planners just avoid it. But they do on an income statement. They'll put in what that income is, but they still don't know how long it's going to last. So in terms of modeling it, because it is a bond, looks just like a bond, except the actual maturity date is a bit of a random variable. So we go and use your life tables. Well, not yours. Social Security has an actuarial table based on your current age, how much longer you expect it to live, and that gives us a reasonable end date. So since it's a bond, it has duration. It has interest rate risk, and we have to include that with the other bonds we have in our portfolio to come up with a final bond interest rate risk assessment and measurement. And the same thing applies to adding a private investment down here, ABC Storage. So he has a relative or friend or whatever that's in this business, and he invests $10,000 in it. He expects a 15% yield. So we need to know all those risk characteristics to say, how does this fit in our stock portfolio to get our lowest risk possibility for a given expected return? What it does mean intuitively is that this is a small cap stock under $1 billion. That's what small cap is these days. Okay. Right. So what we do know is if this is part of the portfolio, without it, we'd have a level of small cap investment, and whether it's value or growth, the other characteristics, whatever they are, once I add this, it means I will need less of that in my liquid asset portfolio to get a most preferred efficient frontier solution. Now, same thing with the pension fund. We're going to need to understand that's part of your total bond portfolio, and without accounting for it in your investment strategy, you're probably going to be way overweight bonds, so it needs to be part of it. The other dimension that's part of the holistic planning and wealth management is your home mortgage. That's also a bond, and a very easy to evaluate bond because it does have a fixed time period to pay off the loan, and every monthly payment is the same for the entire life of the mortgage. So these three are typically not on a balance, let's say a total financial planning and wealth management strategy. So we need to include it. That's important. And I kind of like to emphasize that these are obviously important issues, and people may talk about it, hand wave it off, or make some other excuse. We were counting it mentally or something else. And that's to avoid finding a solution to the problem. So here we're going to go for solutions. We're not just complaining about these things like everyone else. We're trying to fix the problem by putting every asset and every liability on balance sheet. So we go from here to planning. This is where Jane Fluent's running this. And we've been using the Fluent family before. And notice they have a current net worth of $1,362,000. So it shouldn't be a surprise that these first four goals are already accounted for. They can make those. Now, with some of the less liquid assets, like a home, they can either take some equity out or sell it and downsize later on. So there are a lot of opportunities to change it, but they can definitely make it with these first four without, and that includes the remainder needed for Jim's retirement, an additional $431,000. He's going to retire fairly soon. He retires here when Jane is 59 years old. So we can kind of see this isn't too bad. And the idea that we're going to commit to save $60,000 a year or $5,000 a month. So you can see that down here. This is for Jane's retirement. And they're going to leave a legacy of $1 million to their heirs. And we have it set up for 2065. So it's towards the end, or if not the end. And she's saying all she needs is this $50,000 a year after retirement, which makes sense because Jim is going to also require 50, or at least 100,000, but his is going to start much earlier. So that means money's not coming in from working. Human capital's gone to zero at that point. And the fact that he's withdrawing money at $50,000 a year is going to reduce the growth of net worth. So it's somewhat flat, but it's still upward sloping because the portfolio is still going to give off enough for that $50,000. Otherwise, it would be downward sloping. Let's just see what they put in. Any growth in savings? Wow, a big 20% here. So they intend to save heavily beyond the $60,000. And that may be consistent with income growth. And for withdrawals, they're going to withdraw first $50,000 for her retirement, and then that's going to grow at 2% a month as an inflation definition of needing more to buy the same amount of goods after the first year of retirement and on beyond that. Health put down as good. What would happen if we change this? So she's really healthy. Well, she is just increasing her life expectancy from 85 to 93. And that could be a hedge also against a plan where she doesn't want to run out of money before the end of her retirement. We've got taxes in here somewhere. Yes, I believe it's here. So 25% now. And this is our definition of effective tax rate. Here, what we call effective tax rate is not your accounting type on tax returns, because that doesn't include your strategy to minimize taxes. So if you're using 401k plans, IRAs, municipal bonds, any of these things are not taxable income federally. So that means in terms of what we call an effective tax rate is how much tax you actually pay divided by your total taxable income. That can come right off your tax return. But we need something that also incorporates things that aren't in your tax return that are income that's tax free at the moment. So we take the income from your tax deferred accounts and add it to the denominator. So your strategy, you'll see it'll have a lower tax rate effectively for your tax location strategy. So that's all built in here. We've got a little calculator to make that more clear in the process. Something else we're doing here that's new. Take a look at the efficient frontier you're facing and notice that there's a lot more dots in here. All right. What we've done is provide, after the money market fund, usual lowest risk, it has risk to reinvest, but it's kind of the lowest expected return with the least risk. And then when you want to go up the frontier further, now we're giving you many more choices. Not really giving you, we're giving it to the algorithm here. That's going to minimize risk for every level of expected return. Now, what we did now is before, we just had, let's say for the stock market, we only had two things. We only had the total U.S. stock market, which is VTI, and we also had VXUS, which was total international. Now we're going to make have 7 stock funds to use. Let's look at the interesting part. We're still going to keep VXUS for your international component, and the process of minimizing risk will determine what weight should be there. It's not fixed. It'll be determined. Then we have, this is Russell 2000 value and Russell 2000 growth. Okay, now together, that's all a small cap. Why do you think we might want to separate on the basis of growth and value? The reason is value, from a tax location point of view, is what you should put in your 401k or IRA. The growth, which has close to zero, if not zero, dividend yield. So that goes in your brokerage account. You still have the same net result of the whole small cap market being available to you. But we're just going to break it in these 2 pieces. And there's a weighted average of those 2 that would give you the whole market for small cap stocks. But we're going to do the same thing for mid cap, value and growth. Same thing for large cap, value and growth. Now, I can select a set of weights that will exactly, I shouldn't say exactly, let's say 99%, will match VTI and VXUS as we had it before. But now we have the degrees of freedom to say, value and growth, this is always very interesting. Back, all the research that were coming out of academics up through 2000 or so, all said that small cap value was beating everything, every other sector you might want. So they viewed it as, here's another risk premium out here that's being realized. We have less information on small cap in general, and small cap falls out of small cap 1 or 2 ways, either by going bankrupt or moving up with success to mid cap. So you want to catch those, certainly, that move up. And between growth and value, what would you think in terms of the odds of moving up? I would think growth in today's environment. But back then, it wasn't the same environment. All the research said small cap value. So there are whole firms, investment firms, had bet on that as their strategy, as their principle, coming from academic research. But what do you think happens when everybody starts buying that subsector? Price gets bid up, right? And what happens to expected return for the same cash flows? It goes down. So after 2000, growth was beating value. This is what I mean by regime changes, non-stationarity. The world does not stay the same. So at any given time, we're going to have the inputs here on both of them in terms of contribution to expected return of the overall portfolio, as well as contribution to the risk of the total portfolio. Those are the important measures, and they vary. So we will be able to manage that. Same thing for mid-cap and also large cap between value and growth. What you've been seeing in the markets, if you're looking, you'll see that, and I hadn't seen this in years, okay? Never, okay? Till the last several years. And if you look at the markets every day, the Dow Jones Industrial, they happen to be going up when the NASDAQ is going down, and vice versa. What happened to this common total stock market influence? It's still there, but the betas are very different. The response in growth is way over 1.0. It's probably averaging about 1.5 or so. And individual companies like NVIDIA is 2.8. 2.3 for its beta, as I recall. So that creates a lot of volatility and in the opposite direction of what the value fund is doing. So you will see that the value, which we're going to represent by the Dow, is weighted more towards value stocks, and the NASDAQ is all growth almost, but the S&P return falls in the middle between the two. So they're not as all positively correlated as we have grown to expect. So that means we're in a period of regime change again towards growth. And the thing of worry there these days is just that we're bidding up the price of all the firms involved in AI, but they're not all going to be successful. And I still like to know more about. They're spending hundreds of billions of dollars and I'm virtually for free. So how are they going to monetize it, all this investment, and what will growth be like in their earnings? So we've got a lot of issues there. Now, one of the best ways to do it, I don't have to pick the exact firm. If I bought the whole NASDAQ, or I bought this whole growth sector. So you can diversify those bets, and you don't really care who wins because whoever does is going to be great for the overall economy, including the value stocks. We're also getting a big bump lately by using a lot of AI at a very low cost right now. And that will just get better. In the bond market, we saw that we didn't use previously BND. BND was a representation of the entire investment grade bond market. Why would we put nothing in it? We'd rather have more in money market funds and more in stocks. And you'd have a point on the frontier. If you start adding the whole bond market, and remember, this is a lesson to those that use rules of thumb. I should be 60% stocks, 40% bonds, or the opposite, or 70-30. We're showing zero in the optimization. And risks are bundled together. I might like investing in the corporate bond market, but if I did it with a long-term corporate bond portfolio, I'm getting a huge amount of interest rate risk with a high duration strategy and huge volatility from that when it's not offering much, if at all. So how do I eliminate that? How do I break up the risk dimensions in a way that I can separate corporate mortgage and interest rate risk on governments? Well, look at what we're doing here. We need VMBS, which is mortgage-backed securities fund. That's part of BND. You've got short-term government, intermediate, and long-term. And we have corporates, short-term, intermediate, and long-term. I can replicate with these funds exactly what BND is offering. But those aren't the best weights. I don't want anything long-term in this market. But I like the credit spread that's in short-term corporates and in mortgage. So I can separate the risk dimensions somewhat here to get the ones that are offering the most for the amount of risk they add. So with all of those funds, which is a total of 15, we can see that there aren't 15 here because a lot of them were not very useful. In fact, they would reduce and go below the efficient frontier portfolio. And what did we bet? VCSH is the short-term corporate fund. And notice it's got a relatively small contribution to risk, 11.33%, while its contribution to expected return is 4.95, which is about 5%. So we put 60% in it. I don't see any other bond in here. Not even the money market fund that's government securities behind it. Because this dominates by so much. Its own expected Sharpe ratio is 0.5, which is the highest here. So that's going to play a big role. The important number is risk contribution in the last column. Well, I like to look at these too to see what's being offered on their own. So actually, the next highest is 0.49, and we get that from no other than VUG, which is the large cap growth fund. Now, we also get, and we're putting 16% in that, expected return way higher, but its risk contribution was also high, and I think it's the highest among here. But because of its correlation with all the other securities in here, it's getting a sizable weight at 16%. VTV is also in here with the next highest percentage, large cap value. So now I know if I'm going to use this implementation, that I'm going to put the value, VTV, in my 401k. And I'm going to put VUG in my brokerage account because it has almost zero dividend. So look, wouldn't you like to earn more after tax? So by using this set of investment opportunities, we're able to also tackle immediately the tax location position. And the way we're going to do it is just a simple algorithm. You would say, why don't I start with the highest dividend yield or interest yield security? And that goes right to my 401k. And then I'm going to work my way down. I'm going to rank by dividend yield and interest yield. And when I fill up that 401k plan, the rest goes into my brokerage. And I'll have the least tax exposure from it. Here it is, mid-cap growth. So that's another growth fund. And the international fund. National is getting a pretty small weight of 2.5%. But its risk contribution is low too, as you expect. So that's this portfolio. If I go back to the top and say, well, wait a second, I could run out of money with a 5% chance, the worst 5% outcomes in the path. And remember, these are only 3 positions in the path. What's expected, what's the top 5% and the bottom 5%. Remember our graph of path dependency. So there are a lot of strategies that bump around all 3 of these to end up here at the end. It's only expected that we end up at this point, but there's a higher probability we're not going to be there. That's almost a 0 probability single event compared to the infinite number of outcomes along the vertical line. So keep thinking behind this graph, there is a path. And as you start out, if you're ending up near the blue path or even over it, that changes your decision about future strategies versus if you hit the red or close to it, you better make a change. So this is the point where we're planning. We're trying to find a portfolio. So I'm going to look, if I did the high risk strategy, I'm running out of money with a 5% chance, 27 years before the end of retirement. That's the bad set of sequence risk. Down, down, down the first 3-4 years. That's like flipping a coin and it comes up heads 3 times and heads the losing outcome. You could be running right near that line. That doesn't mean the probabilities have changed in the future. It might. There may be an indication that probabilities change that should go into your decision of changing your strategy. You have time to recover, but you're recovering from a smaller base. Just getting back to where you started gets hard. So just think about that start and where you want to be early on in terms of taking bets that can ruin you. Got tax rates. Down here is the benchmark strategy. That's what we're solving for. And notice what we do in this part of the benchmark. We say we take each one of these. So let's say VUG. They're holding cash. 3%, very small, but mostly stocks to get to their weight of 30.03%. So we want to know our risk exposure that the fund is giving us. It's easier the way this was developed. If you use the balanced fund, it might be 30% in cash. You can do that for yourself. Why would you have to pay somebody else to do that? I'd look for a fund that has, if you want more of the stocks, I'd look at one that's more pure stock, which VUG is and VTV is, at very low expense ratio. You want to get the labels we're putting on for a particular sector, exactly what you want. Now, here, you've selected weights for your benchmark, not because of just this division of what's in each portfolio, each underlying fund investment, but you picked them because we're defining the risk dimensions of the bonds. That's how we're choosing the portfolio and the risk dimensions of the stock. It's not that they're a stock, I can do 30% here in stocks with just one stock. That's not going to be a good diversified strategy. That's what we get down here. So I want to emphasize this for a second. Obviously, growth is not what they want to do, and they may not want to do some form of preservation. And you see, that might grow to a possibility of 6.9 million or 4.9 at the time of retirement. Yeah, this is very low risk strategy, but it's also lower return in possible outcomes. So let's see, is it worth taking some more risk? Get higher returns. Okay, now we're up to 6.4 here at the beginning of retirement and 13 million expected at the end. So let's keep going up the efficient frontier until we find a strategy we're comfortable with. So there's less than a 5% chance of running out of money over your lifetime, not next month, not next year, over your lifetime. And here's your savings plan and your investment strategy. Okay, so let me emphasize one more time. Your planning process is to set up a benchmark strategy or strategic asset allocation that you could implement. You don't have any special information. You're using the information that's in the market today, looking forward about what the expected returns, all the covariances that go into the calculation of any point on this frontier. And the one you're most comfortable with is right here. Okay? That's giving you an expected return per year of 7.247%. with a risk level of volatility of 11.3. You put all your money into VUG and it's 20. Gives you a little more expected return, but that's the kind of risk that starts throwing you into those times of risk, times of ruin, which is a big risk. All right? Everybody get this methodology, seen it in your investments course. You're seeing it again here applied, but the application versus what a textbook shows you is we're not allowing short sales with no cost, full use of the proceeds, which is a textbook version. So we're implementing that. We also implemented taxes and all the constraints that go with it. We're measuring it in terms of downside risk, this red line, with a probability. Now, being younger, you might make this 10%, thinking you still have more time to go ahead and retire. You've got your exact plans for retirement, your savings decisions, your withdrawal decisions, your health, and your timeline. When are you going to retire? Now, if it doesn't look so good, the pattern, you'll have a choice. You know what? Maybe I should not retire at 66, but if I put in 70 here, then I don't have those withdrawals coming for another 4 years. Does that help with what my savings will earn? It depends whether you like your work or not. So there's a lot of dimensions. There's a part of retirement that could be rather boring for you. But here we're using, I always call it, you may notice I have pet peeves, and I always call this what it is, expected return versus volatility. When people use the words mean variance, which is the original Harry Markowitz approach, because back in 1952, we didn't have asset pricing models. So people thought, well, if I use the last, 5 years of data to estimate what the mean return is and use that. Now, what happens if it's negative? It could easily be negative. Do you believe it? I hope not. Doesn't make economic sense. Why would people pay money for a negative return that increases the risk in your portfolio? That's bad, not win-win. So you have to think in terms of that and say, well, how should I think about the future, what I'm investing for? That's going to be a probability distribution out there. And I can describe it with an expected return looking forward. So what do we do these days is we go to asset pricing models for that data. That makes sense, and the inputs are very straightforward. That's what we're going to do. I'm going to show you all that in market analysis again. So years ago, when I programmed an efficient frontier, typical method was this historical returns. IBM can't be negative expected return. Why can't it be? It's positive beta. It must be the case for that to have happened. If that were true, the price would have been bid down, which increases expected return. So it can't be negative. There are other negative beta type securities with a lower expected return than the risk-free rate. Those are usually insurance contracts of some sort where you're selling away the risk and you're willing to pay for that. Or in some other circumstances, I'll show you later. But this is expected return versus standard deviation. Why am I making such a big deal about that? And my pet peeves are because of how do you assemble sensible estimates for these important parameters? The second reason I'm emphasizing it is all these securities, bonds and stock portfolios are out there, available at very low cost, and we didn't use any special information here. We just did some economic analysis with available data. There's nothing in here about tactical trades, or even at this point, later it's the implementation when we'll send the right securities to the right accounts. But anybody can do this, very low cost. So it makes sense from a planning perspective, which is up here in these graphs, that all of this is reasonable. Anyone can do it. No special information. We want that as our strategic asset allocation, which will represent what we can do very easily with measures that explain the risk and return very well. Now the question is, how do we add our illiquid securities into this? How do we make it even more real world and at the same time measure performance, meaning that you can do this, that fits you perfectly. But if I'm going to do tactical trades and other trades, let's see if I can outperform it. That's a fair measure. It's got a risk level and expected return. So on a risk-adjusted basis, can you beat this? Remember, a benchmark strategy or strategic allocation has all those weights to it, all these investment weights. So we know what that portfolio is going to do. What is also nice about starting out with a benchmark, which is just by definition in every institutionally managed, in mutual funds and ETFs, they pick their own, what they like. But here, let's say I do decide to go heavier in growth. Well, if I'm going to put more than this 13%, 13.6 in growth, where's the money coming from? Let's say it comes from value. Add a percent to this and decrease a percent to that of total portfolio. Now I've created something that is deviating from my benchmark. That's equivalent to saying I'm taking an additional long position on VUG and I'm shorting VTV. Even though I don't go call a broker and tell them to short this. I'm not. A short position is anything less than your benchmark. The reason for that is think about what might happen next year if VTV outperforms VUG. Right? VUG comes out with a return less than expected and VTV greater than expected. What's your performance? It's a big negative. Why? Because you lost a good positive return here and you had a negative outcome in VUG that you overweight. Where are your overweights? Where are your underweights? Then we can say, if we're good at this, fine, right? Keep doing it if you like. But if you're not, if you can't beat this sensible benchmark without taking on too much additional risk, you ought to stick with this. But this will change. As market conditions change, you get to review this and make changes after that optimization. But this is still in a world of all liquid assets, all right? Now, how are we going to move to incorporate more real world situations? And we go to portfolio. Okay, now this is the same portfolio, you can see, but we're not going to use that expected return variance. Why are we not going to use it? What's our problem? Let's take ABC storage. Anybody have data on that? To compute covariances with every other security. Nope, not likely. Pension fund might be easier if we used a proxy to do some correlations. Expected return would be tough. We've got a house here. What's the saying in real estate? What determines risk? Location, location, location. You ever hear that? I hope so. So we got to do some special things here. And we have to live in a constrained world where my objective is to get close to the benchmark. Now, when I think about that, and we do this in finance in several other places, I'll give you an example. We do synthetic replications. So later on, when I show you a protective put strategy, now the value of the put as the underlying stock price moves changes dramatically, actually, because it's got a huge negative beta. The only other underlying is the stock itself. So you can hold the stock, or if you'd like, better, the S&P 500, a portfolio stock, because there are options on that portfolio. And if I take a protective put strategy, just means that if stock prices go down, you win from your option. You get to sell it at the exercise price, which is now going to be higher than the stock price. So I make a profit, and I offset that profit dollar for dollar on my underlying stock. So for downside risk, that's one way to manage it, by puts. Now, the question is, gee, that's a little complicated. I got to buy a put, and I got to buy the right amount, and I got to do this. I have to roll it over. When the put option matures, then I got to buy another one that's out further. So it takes a lot of monitoring and execution to do that. But there's also a replication of that strategy where you're basically getting the same set of outcomes, but you're just changing the weights between the stock and cash or money market fund to get to the same beta the protective put strategy has. That's a lot easier. It's just formulaic. And you'll have a map of if stock prices go up, what do you do with the put price or the cash position? And vice versa if stock prices go down. So replication, anything or any strategy that has the same set of outcomes will have the same price for it and same risk dimension and expected return. You can actually replicate. So what the approach we're going to do here to deal with all these illiquid securities and those that don't have data for it, we can at least say, what are the risk dimensions? So if I were to open these up and say, what's the pension here? What are some of its risk dimensions? I'm going to go up here and hit bond details. And then I can go along and say, oh, well, it's 100% bond in our classification for dollars spent. It's all U.S. It's all AAA, government issued pension. It has an even distribution along the buckets of years. We'll be able to manage it with its effective duration. And if we go further down here, we've got those buckets, and then we have it's a government bond. So it doesn't have credit risk like corporate bonds, etc. So we have to just indicate what the risk dimensions are in our definition for bonds. And the same sort of thing for our investment. Now, anytime I've told you, I'm just going to do this as a reminder because it's very important. You have to realize when we do this replication optimization, any account that is single security, unless in advance I could sell it and move the money, it's not going to change. The optimization is working with that as a constraint. And that's the same thing it's doing down here for the mortgage and for the home and for the ABC storage investment. It's like putting a hold on it, like we did last time. Okay? Now, this account is a brokerage account. It has opportunity to put more securities in here. Okay? Was there a question? Okay. An opportunity to put more securities in here, but not in the fixed item. So we're going through it, and we're going to go by all these dimensions for bonds and the ones we have for stocks. So what the algorithm here is going to do, this is what we call the WealthFluent optimizer, to differentiate it from the Markowitz type optimization we did earlier. Here's where we're picking our actual portfolio. And we're going to compare this in the dashboard. The lower row is your benchmark. And you can see we're already got lots of reds. So we know we're nowhere near it at the moment. So how do we get there? Let's start on the optimization. 0.36% matching. And notice the total standard deviation that's minimized is very little. And look at all the reds here for all the stock and bond components between minimized, whether you're looking at it in dollars or in percentages. It's off what the benchmark is. So what's going on? Why can't I get closer? Well, we know this is the idea of looking at a portfolio before you even try an optimization. What do I know? I saw that I have a pension with an annuity. I have a mortgage that's an annuity, but they go in opposite directions. One's cash inflow, the other's cash outflow. One's a long, one's a short position. They're going to offset each other a lot. So all I have to do is deal with that difference in the bond world. In stocks, we know already is pretty bad because there's only 2 stocks in the portfolio. Very poorly diversified, both in the high growth, large cap sector. So none of the other sectors are represented where you can get some diversification. So fortunately, we have this assist method. And we can go through a few things. Bonds, let's just put in all the bonds that are in our, I'm going to get this to be changed so that you can do all at once. But in the meantime, we're just adding them one by one and allowing them to go into any account. It's later when we do the tax adjustments and do, if you want, some, shall I call them, tactical trades. By the way, tactical trades is not just on one stock. It could be saying, I believe the whole market's about to do better than expected, so I can do a macro tactical trade and increase the beta of my portfolio to get more reward. And you can also say specific industries could be worth a tactical trade at the moment. Wow, we went from 0.3 to 79%. Just by adding more flexibility and opportunity for the bond investments. And now we got a lot more greens. Oh, but not in stocks. Let's see what tells us we're underweight and could use more. How about stocks? And now I have the opportunity to add what's in the benchmark. I got to make this a one-click operation, which I will, but not right away. Okay, so we've got almost, here we go. Now we got all the combinations we had in the benchmark to be able to get close to the benchmark. Let's see, how do we do? 90%. That's pretty good on its own, given the illiquid assets here. So what we're doing is taking into consideration the risk dimensions of all the illiquid securities, even though we're not going to intend to buy or sell any of those. So we've handled that real world problem. And the only red here's more just for AAA. And the other red, corporates are underweight and governments are overweight. Now, why would you think that could happen? Real estate, so it has to come out of something. Why are those bond numbers a little odd? Well, first of all, they're being measured and optimized by these buckets, 1 to 3, less than a year, 3 to 5, 6, 7, etc. And the big long one is over 30 or 20 to 30 years. Does bucketing have any flaws to it you might worry about? And notice here in bucketing, we got 2 yellows. That's not so bad. I don't see a lot of red. We saw maybe some red over here with government, mortgage. And we're doing pretty good, just AAA as an overweight. Why would I expect that even before I ran the algorithm? Well, I know in advance that I've got a big position from my pension fund and a big position from in my mortgage, forgetting the other funds we've just added, which are all down here. We've got some other bond funds trying to minimize those differences, but also get the nice high expected return. I get exactly, if I could get 100%, like I showed you I could last week, but it's not feasible at this point. And with all those different bond components, putting them in buckets and trying to minimize the bucket difference, is that the best way we can match up? Is that an accurate measure? Let's take a mortgage as an example. Investing in a mortgage fund. What duration? 30-year mortgages. What duration would you expect? What volatility would you expect? Where is it coming? Remember, duration is a time-weighted present value of each cash flow. So what happens if rates go down? People in that pool of mortgage will refinance. When they refinance, the cash flows are over. They get the whole principal back in year 2, if that's when they refinance. So, cash flows are only moving forward. There's no big principal payment at the end. They're in every single cash flow. But you get it all back in one shot when there's a prepay. So when payments move up, the duration drops, the sensitivity to interest rates drops. So what happens with mortgages is as rates go down, the duration also goes down. It's related to the path of interest rates. And when interest rates go up, there's less probability of a lot of prepayments in there because it's the options out of the money. They may prepay to move to another house, so there's some for that. But what happens is duration extends and becomes longer. And since it's fully backed by the U.S. government, we consider it AAA government as well. No credit risk. So that's why there's an overweight in government and an overweight in AAA. Because we consider the pension AAA, which doesn't have a prepayment problem until someone passes away. That's for the actuaries to figure out what those likelihoods are. But notice duration is telling you all about the timing of the expected cash flow. There's a lot of probability, 50%, let's say, for rates going down and 50% rates going up. And with the probability times the change in expected cash flows, that changes interest rate sensitivity. So are we better off bucketing or using duration? I hope you all are saying, yeah, duration. We've got it here now, and we even have key rate durations against different points on the yield curve, which will do the analysis. I'll show you it's not particularly hard to do, but we've already calculated them here. We just have to put it in as an option in the optimization, not do buckets, but do duration, effective as total, and key rates. So we're moving towards that. Got it up here already. And you're going to need this information for your assignment later on managing a bond portfolio. Okay? So you'll have the information to do performance measurement and performance attribution later. So can we do a little better? Maybe. Oh, it still has a lot of things here. I could add some corporates. I could get a little closer, but having known this, I'm not going to do very well. I'll get another % up, maybe. So I don't want to spend the time doing it, but you can, especially when you're doing your assignments. You'll also see, in terms of the weights, look at this. Put nothing on government long-term, putting nothing on intermediate or government short-term. Or at least in this account, no VMBS, no mortgage. Okay, so we're down on Apple and Tesla. We're almost selling it all, but putting money in, as you might expect now. VTV, VUG, those are the bigger components. VOE, which is mid-cap value, and mid-cap growth. So we're kind of getting closer to replicating VTI here. And we do come even closer when you go across all accounts. You'll see less bonds, but which bonds do we like? We like short-term bonds. So we can minimize interest rate risk, but I might like the credit risk, the additional spread giving me additional expected return versus a short-term government fund. That's going to dominate, and mortgages might help. So here you can look over the actual portfolio and you can actually delete all the zeros if you just want to make watching it easier. So we got a strategy. This tells you what to sell and what to buy in the revision section to get where you want. But we haven't done tax location. The way we did it in the past is we went and looked and said, where's the fund, the accounts that are exposed to taxes? And I don't have choice with the pension fund, 401ks. Here it is, the brokerage account. So what we did before is go through here and look at those things that are high dividend yield or interest rate yield And if there are any in here, we make them zero, put a hold on it, so re-optimize so it forces them into the tax deferred. Now, in ongoing management of your portfolio, if it said, hey, I don't want this money market fund here, I want to put it in my tax deferred account. Do you actually sell it here and move the money to your tax deferred account? You know, you can't do that if you're already at your max contribution. What it means is you just change the risk dimension. If I need to sell a money market fund here, okay, I can do that, right? And I can buy, make sure there's a money market fund in, as an option, in my tax deferred account, and then just re-optimize. Because if I put a hold on it here in the brokerage account, this is, I believe, yes, it's not going to allow any investment in it. Go to zero automatically. Where else is that investment available? Oh, it's in my tax deferred account, so it will add it over there. But you don't move money between the two accounts. You just move the risk dimensions by the assets you select in each account. And so it's all about risk dimensions here in terms of minimizing it relative to the benchmark. We want to minimize those deviations, and that's what we have in these columns, in dollars or percentages. And when they're green, they're very close. When there's an overweight like this, it means there's some form of constraint that's unique to my portfolio. And that's because so much of the bond assets are AAA rated. And if you can overweight that, you can underweight other things in the same subsector. And it doesn't look there's any reds in there. Here we got not too bad, but of course, corporate bonds is underweight and governments are overweight, as one would expect, from the constraints we're living. Any questions? These are two different optimizations. I just want you to understand. Planning is different than portfolio, and portfolio is your final outcome. Now, what does it mean to be 92% compared to where you were in planning? Now, in planning, you selected this portfolio that had a standard deviation of 11.3. Now, assuming for the moment, let's make it easy, that the expected returns on both portfolio strategies are the same. What is the risk of your actual portfolio we just solved for? To try and get as close to this as possible, what is that portfolio standard? Higher, lower, same? Work our intuition here. If this portfolio, that is our benchmark, has the lowest standard deviation possible for that expected return, if I can't match it, but I had the same expected return, that portfolio is going to be here. More risk for the same expected return. It's going to be under the efficient frontier. Now, in the case we just did, you didn't have any choice, really. It was the real world constraints that gave you some more risk. If you do a tactical trade that way overweights a particular security, we could name a few that liked in the group. What are you doing? Same expected return. You're moving out to more and more risk and getting further below the efficient, unless you have the special information to say it's worth it. And that should come from a very careful security analysis. Or in the case of making a macro bet on markets, interest rates, and the S&P 500, or a industry effect. Those are three kind of more macro-oriented. And for security selection, that usually refers to one security, but it could also be industry as well. And that's where tech is being bet on heavily. And we have to see if those bets deliver. So if you pick a portfolio that's viewed by the market as down here, okay, which is taking on, well, let me put it over here. So for the same expected return as the consensus believes, taking on much more risk. How are we going to find out how that worked out? We're going to find it out by doing performance measurement. Did you beat your benchmark? By how much? And how much more risk did you take to say it's worthwhile? You get a little indication that if I added a security like maybe Google, that I think is going to really outperform So I'm going to overweight it by 20,000, 50,000, whatever I choose. I know I'm increasing my risk. The question of whether it was worth it ex ante is to say how much additional risk did I incur and how much diversification did I lose. Percentage gives you an idea because that's called ex ante when we're constructing our portfolios. But ex post is performance measurement. And that's where we'll find out whether the performance is above or below risk adjusted measures from the benchmark.